just upstairs, you were talking about this change in the monetary policy implementation system as being about the piping, not about the temperature of the water that's rushing through the pipes. Can you elaborate a little bit more on that?
Yeah, so what we've announced today is a new system for implementing monetary policy, what we'll be transitioning to in the future. But I wanted to emphasise that really is about the plumbing, the nuts and bolts of moving money around, about us achieving our cash rate close to the cash rate target, but it's not what that target is. What that target is monetary policy. This isn't about monetary policy, it's just how we achieve the target at any given time.
But it's also about responding to perhaps some of the imbalances within the system structurally coming from the last few years.
Well, it's about responding to the running down of the very large level of reserves. We call that excess reserves that are in the system, because we and other central banks pursued unconventional monetary policy. So they put a lot of money in the bank's accounts. Those are gradually unwinding as our bonds mature, as the TFF gets repaid. So it's about looking to the future and thinking about how, what we need to do to sort of what system we need to transition to.
When it comes to the moderation of that balance sheet, obviously a lot of it will depend on underlying demand, but do you have sort of an idea of scale, of timing, of how that framework will play out?
No, we don't, and indeed that's partly why we picked the system we've picked. So what we've chosen is what we call a full allotment allocation system at our OMOs. That means the banks come to us and for a fixed price they can borrow reserves, pledge collateral for 28 days at the moment, and they can take what they want as long as they have sufficient collateral. So what that means is the supply of reserves is going to depend on the bank's demand. The banks have their own estimates. We could come up with some rough ones, but until we get there we won't know. But it should transition fairly seamlessly from one of excess to ample, and we'll know we're there when banks start showing up in larger numbers and larger quantities at our operations on a weekly basis.
I think until we get there we won't know, probably, is a good phrase to describe a lot of aspects of where we're at the moment in terms of monetary policy. Upstairs you were asked, a little bit cheekily to give one word to describe monetary policy settings and trajectory. I'm going to give you a few more words if you want. Can you elaborate?
Yeah, I think the starting point is just to say that the board's made it clear it thinks the interest rate path that will best bring inflation down in a timely manner is uncertain. And so they've not wanted to rule anything in or out with regards to interest rate changes. We're in a better place than we had been. Inflation's come down a long way. It does look to be moderating, but the path, according to our forecasts, is a gradual moderation from here. Labour market pressures, they're easing. They're still tight, but they're easing, and that's because growth's slowing, and so that brings demand into a better balance with supply. So all those things are in place. Our central forecasts are sort of predicated on sort of further good things happening, including productivity growth, but there's a lot of uncertainties around that, and I think the key point is those are reasonably well balanced as best we can tell, and because of that, the path's uncertain. The next rate change, don't know if it's higher, don't know if it's going to be a lower interest rate.
When you talk about the inability to rule out shocks, right? How much of those risks do you worry about that might be external, that might be geopolitical, that might be election-driven, the policies of other countries, and how much of it are sort of domestic, maybe structural, macroeconomic aspects that perhaps we haven't seen in the data sets yet?
I think it could be both. We just don't know. But I mean, as a small open economy, we're always subject to developments offshore. We've talked quite at length about what's happening in China. China's a major export market for us, and there are concerns there about their property sector and the problems that they're trying to deal with there. So that can have an impact on things like the demand for our key commodities like iron ore, and that can move our economy around. But equally, domestically, things can be moved by what people here in the Australian economy are doing, particularly households at the moment. How are they going to behave in the future? That will sort of be a key a key point for where the economy goes.
And households, actually, I wanted to get your views on, in particular, savings data, which I know you look at quite closely. There's been a lot of concerns about global debt, right? Government debt and household and private debt. And in Australia, we know that the latter dwarfs government debt levels. What are you seeing in the data at the moment when it comes to household saving and spending, and are you concerned?
No, I'm not. I think what you can see in a number of different places is household savings may be holding up a bit more than people would have thought. And I say that because we know household consumption is very weak. And households also built up not all households, but many households built up a big buffer during the pandemic. And they're running that down, but running it down quite slowly. And households with mortgages are still paying extra overall, not all mortgage holders, but overall households with mortgages are paying extra into their accounts, into their offset and redraw accounts. And that's holding up around the sort of average levels, even picked up in the last sort of 6 months. I think that's a sign that monetary policy is working, because one of the things that monetary policy does is when interest rates are high, provides an incentive to save. So maybe that's telling you monetary policy is working.
The same sort of rhetoric you're hearing from a lot of central bankers trying to navigate this last trickier leg of this policy cycle. How difficult is it to be a central banker in this environment at this point in time, after everything that's happened in the last few years?
Look, I think they always sort of want to look with fresh eyes at all of the data that comes in. But central bankers also need to take a slightly longer term perspective and be thinking about the trajectory and weighing up all the sort of bits of information that markets get very excited about, but it only adds incrementally to what we really know. And I think all central bankers at the moment are just looking, are we really on this path where inflation will come down, labour markets, which have been very tight, will ease, but not too much, so that unemployment rate won't rise too much, and we can hold on to all those employment gains we saw during the pandemic, particularly here. So, I mean, it's always a challenge, but that's the job. That's what they're doing.
And financial markets have still remained very sanguine about the potential risks in what this next part of the journey looks like, right? Are you comfortable with that optimism? Do you think, for Australia at least, we'll stick another soft landing and, you know, keep being the lucky country because of better monetary policy?
Well, that's what the board's very much focused on, trying to bring inflation down, but in a gradual way, so as to maintain as many of those gains in the labour market as possible. One never knows. I mean, private markets, equity markets, private bond markets, they're fairly richly priced at the moment, and we've made references to that in a financial stability review. So the central bankers would be watching for those markets, and there's always could be a period of adjustment. But as I said upstairs in response to a question, financial conditions here in Australia, those sorts of things are important, what's happening in private markets, but a lot of what matters is just what's happening to the cash rate, what's happening to BBSW rates, what's happening to the short end of the yield curve. That's the nature of our markets.